Hello traders, welcome to the LFB and our global video charting review. This is for February the 16th, 2011. My name's Marco Haig, I'm from the LFB Trade Desk with all of our content courtesy of the automated trading program that you'll be looking and reviewing through today. Please note that Forex trading does involve substantial risk of loss, is not suitable for everybody. And traders should use due diligence when participating in any global traded market. Risk disclosures and disclaimers are posted to the LFB website, and we would ask that you view and accept them before taking any data from the videos. Global equity trade saw very little movement of note on Wednesday outside of the regular slow and steady buying of support whenever a permanent open market operation from the Federal Reserve is undertaken. The POMO auctions buy back treasury notes and leave the primary dealers little choice but to buy risk and as a result to buy stocks. There have been very few POMO days that have not closed the S&P 500 in the green, albeit that over the last 9 months of trade the Federal Bank of New York and the high frequency trading algorithms have made up the bulk of the volume on any given day. A gap higher in overnight Asian trade was really all that equity market participants were able to react to following the regular pattern of trade that has most price action unfolding in the futures market. The Japanese Nikkei moved up and through 10,750, which is a resistance breakout point that now draws in a potential test of 11,000. The Nikkei is a long way from generating any kind of new signal now that the upside target of 10,820 has been hit. European markets are holding their bullish undertone and have allowed the German DAX to test upside resistance at 74.40. Make a note of these numbers because they're going to be very pivotal over the course of the next month of trade. That 74.40 on the German DAX could be a major swing point to gauge price reactions and follow through from. The current long signal on German DAX hit its target at 74.10 with no new signal close to being generated at all. S&P futures, which we're looking at here, and we use S&P futures as the most liquid global equity market. S&P futures found the energy to gap higher in overnight trade in line with Asian equity markets that made an initial long move at the start. The test of 1335 that we saw push up to overnight will now be pivotal in regard to where the S&P can finish February trade. The short signal from 1320 yesterday did not trigger and instead led to the formation of an intraday long move that went from 1328 to 1332 in quick time. In general, traders are witnessing a sideways slog at yearly highs, with most equity markets containing 24 hours of price action in one or two 1-hour chart timeframes. Those not already long may be wise to buy the next test of support rather than purchasing an already extended market. Profitable long positions that have been aided by positive earnings season headlines will soon start to be banked or profit protected. The warnings stay in place in regard to equities that the next high volume move that fails to hold support on the S&P 500 could trigger a near-term long squeeze. Signals will follow on whatever the market chooses to offer. If you do like the content of the video, as you've just seen, you can sign up for the video text of the articles that we have, and you can get that newsletter sign up by going to thelfb.com, www.thelfb.com, and on the homepage you'll see a newsletter sign up which we just quickly showed you the text of, so you can get the articles ahead of the video. Snoozeville in global commodity trade. Global commodity markets have held their sideways crawl over Tuesday and Wednesday, with gold, which we're looking at here, and silver holding the higher ground at the same time that West Texas Intermediate oil trade holds support. We can see the 50-day simple moving average on gold, which is the green line. That's up here at 1375. That is going to be a resistance area that kicks up some sand and will create a little bit of a dust storm for near-term trade. We can also see the 100-day simple moving average, which is the orange line that we have holding a support around 1360, and that's why gold has just got caught in this little spider's web of price action, as two major price points are sitting there as support and resistance. Looking at the silver market, a much more bullish view on silver than gold at this point in time, with silver in historical values looking as though it's got a lot more potential movement, although we are still looking at both silver and gold for long-term long positions that you just wouldn't sell. There are no new signals of note and very little in the way of potential on any intraday basis at this point in time. Inflationary pressure in the global commodity market, which is being generated in part by the manipulation of the US dollar, has led to bursts of energy that tend to be contained in very small time frame trading periods. So, as discussed in the previous client notes, commodity markets have moved outside of their historical role to hedge future commitments for delivery of goods and material, and have moved instead towards hard and soft commodities becoming as much of an investment asset class as they are a necessity to skid the wheels of global trade. In general, traders will be well advised to sit and watch this week's price action unfold, because rather than try and pick a top or a bottom in a market that's signaling fair value has been found, we do have to respect this divergence between oil and gold and silver at this point in time in the near term, because it's just signaling that the global market is happy with what we've got. It's also signaling that these moves in global commodities are not driven by generic growth that's going to take us out of this period of expansion as we come out of this economic trough, but haven't yet led to confirmed growth numbers. Got to be careful here. The dollar index is holding in a 4-day sideways channel at a price point that's been pivotal during most of 2011 trade. We're looking at the euro dollar chart here. Euro makes up 60% of the dollar index, and we're starting to get some potential sell signals on euro dollar, which is an inverted dollar index chart. If you don't have access to live dollar index price feeds, just look at euro dollar, and at 1.3500 on euro, the dollar index is at 78.50. So 78.50 on the dollar index equates to 35 on euro dollar. If we move up to 82 on the dollar index, we'll be down towards 31, 1.31 on euro dollar. If the dollar index moves lower from the current 78 down towards 76.50, which is near term support, that would mean euro dollar would be up at 37.50, 3800. So it's just a way for you to gauge overall dollar values. It's been noted and is well worthwhile repeating that as equity markets hit their yearly highs at the same time that Treasury notes hit yearly lows whilst interest rates continue to move higher, that the dollar index has not capitulated and is still 10% off the equivalent lows when compared to correlated global markets. The signal coming from the dollar index trade confirms that whenever global equity markets fail to hold support, which history tells us they will, the dollar will likely be heavily bought and euro dollar will continue its slide. By default, by design, by manipulation, there are obviously very good reasons why the global central banking community has not allowed the Federal Reserve to completely crush US dollar values in the very near term. In general, history tells there will be a bout of US dollar buying. That's in line with the previous 4 months of trade that's seen a dollar index bounce higher from this area and euro move lower from this area. The current price point of 78.50 has seen subsequent moves to test 82.50 on the index. And if that move follows through again, it would equate to an average of 400 pips of movement for the dollar against the major currencies, and we'd be looking then at euro dollar down towards the 3100 price point. The next move of dollar index buying is going to have nothing to do with US economic outlooks. Moreover, it will be global markets realigning fair value and rebuilding the historical inverse safety risk correlation, equities up, dollar down, or dollar down, equities up, that have been tested since October 2010. We've had divergence in global markets and their correlations, but that should start to get itself back together. And just watch this dollar buying, because when equities make the next move lower, euro dollar is going to drop and the dollar index will get dramatically stronger. Thank you very much for making us an integral part of your trading day. You can find our articles on the LFB website. You can find us as a contributor on thestreet.com. We're a registered contributor to seekingalpha.com. The trade team have represented Futures Magazine and the Intercontinental Exchange and IB Times at Forex Expos. But if you do want to get access to this data and information, you can get it via the newsletter. You can also get trade signals that we talk about via a subscription from the LFB, or you can use the automated trading program that will replicate those signals on your account.